What if your portfolio could pay you every single month? Imagine waking up and seeing fresh cash deposits hit your account like a paycheck, but from your investments. Sounds pretty nice, right? Most ETFs pay dividends quarterly, but a few powerful funds are designed to pay you every single month. Today, we're diving into some of the most exciting monthly dividend ETFs that investors are using to generate passive income. Before I reveal which ETFs we're talking about, let's break down what exactly dividends are. Dividends are cash payments that companies distribute to their shareholders, usually from their profits. Think of it as a reward for owning stock in a company. Some companies, especially blue chip and income-focused stocks, pay dividends regularly, often quarterly, or in the case of some ETFs, monthly. Investors love dividends because they provide passive income without needing to sell shares. For example, if you own a stock that pays a 5% annual dividend, you'll receive 5% of your investment back each year, on top of any potential stock price growth. That's why dividend-paying ETFs, especially monthly dividend ETFs, are so attractive. They allow you to generate consistent income while still keeping your money invested. First up, we have SVOL, the Simplified Volatility Premium ETF. This ETF is unlike anything else on the market. Instead of investing in stocks, SVOL profits from market volatility. It does this by taking a small, controlled short position on VIX futures. Basically, it benefits when markets stay calm. It pays a massive dividend of 16.64% annually, and it has over $1 billion in assets under management. Its strategy is it targets negative 0.2x to negative 0.3x, the inverse of the volatility index, while aiming to mitigate extreme volatility. This makes SVOL a unique high-income play, but also one that carries risks. If market volatility suddenly spikes, SVOL can take a short-term hit. So if you're looking for one of the highest-paying monthly dividend ETFs, SVOL might be worth considering. What if you want tech exposure plus steady income? If this sounds appealing, you'll love JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. If you love big tech stocks like Apple, Microsoft, and Amazon, but also want monthly income, then JEPQ could be the perfect fit for you. JEPQ follows a covered call strategy on the Nasdaq 100, meaning invest in tech giants while selling options to generate cash flow. It pays a sizable dividend yield of around 10% annually, and it has a huge asset under management, over $23 billion. Its top holdings are Apple, Microsoft, Nvidia, Amazon, and Alphabet. The upside, you get exposure to high-growth tech companies plus a strong income stream. The trade-off, because JEPQ sells covered calls, it caps some of your upside potential if the Nasdaq skyrockets. So if you want monthly cash flow while staying invested in the biggest names in tech, JEPQ is definitely a strong pick. But what if you want something even more stable? Let's say you like JEPQ's covered call strategy, but you don't want the volatility of tech stocks. That's where JEPI comes in. JEPI, the JP Morgan Equity Premium Income ETF, follows the same covered call approach, but instead of tech, it invests in blue chip S&P 500 companies. Think Johnson & Johnson, Procter & Gamble, and Coca-Cola. It pays a more modest dividend yield of over 7% annually, and it has a huge asset under management of almost $40 billion. Its strategy is that it generates income from low volatility stocks and selling covered calls. Because it's built on more stable, dividend-paying stocks, JEPI is generally less volatile than JEPQ, making it a great option for investors who want steady monthly income without major price swings. So, which one should you pick? I recommend SVOL if you want a maximum yield and don't mind volatility exposure. I recommend JEPQ if you want a mix of tech growth and a strong 10% yield. I recommend JEPI if you prefer the safest option with a lower but reliable 7% yield. Now, each ETF has its pros and cons, and the right choice depends on your risk tolerance and income goals. I want to hear from you. Which of these ETFs would you invest in? Drop a comment below and let's discuss. And if you found this video helpful, make sure to hit that like button and subscribe for more smart investing insights. I'll see you in the next video.